Up in just a minute.
Sure.
Hello, everybody. Welcome to your TraderMerlin show. It is your Monday edition, kicking things off for what will be a great week of guests this week. We have a lot of different topics to go over. Of course, the last couple weeks, we've had some pretty interesting guests talking about, again, a wide variety of stuff. Bonds, obviously, taking center stage. We talked a bit about some Forex. We talked about some equities. The good news is for today, we're going to kind of do a smorgasbord of topics. As you guys may know, my guest, no stranger to this program or Online Trading Academy, he likes to do something called the Beck Report, which I have it backwards here, but it's actually bonds, equities, commodities, and currencies, and a lot of the interrelationships between these bad boys. And we have had some pretty significant changes in some of these categories. So without further ado, I'll welcome to the show Mr. Scott McCormick, CM to the T. How you doing, Scott?
Doing well. How are you today?
I'm great. I'm glad to have you with us today. It's been a while. What have you been up to?
5'11", 270.
That's the go-to quote right now. Is this why we're not going to use video? Is that what?
Yes. It's all COVID weight, and apparently it's starting to move into my face. So
Oh well, next time I see you, I'll just pinch your cheeks and go, "You're so cute."
I know.
Yeah. All right. Well, market-wise, I know you were doing a lot of the market, not recaps, but kind of the setting the stage for the market each day. You've been doing a lot with the community. What you've been working on from the education perspective?
Pretty much just focusing on that. So every day with Online Trading Academy, I prepare every morning what's called the daily market overview, and then during their guided pathway session, I basically do a high level overview of that, and it'll depend. So like on Mondays, being that this is the first day of the week, we do more of a higher level overview, kind of looking at those weekly and daily time frames as opposed to maybe during the rest of the week, we'll look at like daily and 60-minute or 240-minute charts, depending upon if we're looking at stock-related ETFs or if we're actually looking at the futures contracts. Mm-hmm. But we try to mix it up. So the entire purpose of my segment in that program is to provide kind of the framework, that higher picture context of what's happening inside of the market, so that it just hopefully sets our students up a little bit better for how to approach the market, because if you know what the trend is, if you know whether you're in the impulsive or corrective phase in that trend, then strategically you should have a better idea as to whether you should be looking for long opportunities or should be looking for short opportunities, or I'll plot out, in addition to supply and demand zones, where some of the pivotal areas are inside of the market where we could recognize trend changes. So all of these things obviously start to play into one another, but yeah, so we do that 5 days a week, Monday through Friday, and that's really kind of my focus, in addition to helping to produce some of the levels inside of the mastermind grid, and as I mentioned, writing the daily market overview.
I have to share this with the audience. It's a picture of, let me bring it up here for you guys. This is, if you are wondering where you can find Scott, one of the things that's nice about the My OTA section is if you go into My OTA, of course you have to be an Online Trading Academy graduate, you just search for McCormick and you'll see there's some place you can find him every day. Usually it's at the unspoken hour of 5 o'clock in the morning. As you can see here, he's got all his calendar sessions, but pretty booked out for quite some time. So a busy guy. Oh, and there's the calendar. Sorry, guys, I didn't have it shared with you. But yeah, this is the easiest way to find out where any of the Online Trading Academy instructors are presenting. All right, so your daily market overview. Clearly, one of the major topics that's been going on recently, especially over the past couple months, has been the topic of bonds. It's actually one that's kind of heated up here, and I'd love to get your take on it. We had Jim Rogers on the program. We're saying he's seeing the mother of bond market bubbles forming. Bill Addis also seems to think that there's this pretty significant bubble in the bond market, especially because the Treasury is having to unload so much of the 10 and 30 years to sell these things to service the debt because, of course, stimulus and all these other things to keep America on track and COVID and all that. Anyway, to the flip side of this, we had Stephen Van Meter on the program, which presented a very interesting look at the other side of this, which is he thinks that not only is there not going to be a bond bubble, but we're going to see an absolute explosion of bond prices as those bond yields come crashing down because of an exceptional amount of short interest in the bonds. Because let's be honest, it's been one of the most telegraphed punches out there, knowing the long-term yields are going to spike, meaning bond prices drop. That was easy. Everyone's going to short those. So I'd like to get first, since we're on the Beck report, start us off with a higher level of what your thoughts are on the bond market at this point.
Yeah, so it's interesting. Now, I don't know. I'm not familiar with the last two guests that you mentioned in terms of their time horizons, right?
Right.
But having been an avid reader of Market Wizards, I mean, I literally, well, I don't read it anymore. I listen to it on book on tape, but I will listen to it once a year. And I know that probably sounds a little obsessive, but for me, I pick up something every time, and if anything, it's like incredibly motivating to just listen to these stories. But one thing that I understand about Jim Rogers is his time horizon is, I would say, not measured in terms of quarters and years. It's probably more half decades and decades.
Lifespans.
Yeah. And so, when he says that we're in a bond bubble, it is very possible that we could be at the very beginning stages of that, right? But in order to really kind of give perspective here, and I don't know if you're using CliK or TradeStation or TradingView, but if it depended upon the platform that you're using, you can pull up the 30-year Treasury yield as opposed to the bonds, and you can get some of this data going back into the early 80s.
Yep. I have the 30. You just name what you want to look at, brother, and okay, I'll drive.
So if you take a look at a monthly chart of the 30-year Treasury interest rate.
Yep.
So the ticker symbol on TradeStation, for instance, would be $TYX.X. If you're on TradingView, I believe it's
I've got TradingView. I have both, so
okay.
Just go ahead.
All right, awesome. So the critical area, and I'm a big trend guy, okay, and I think that's probably really important for your audience to understand, is that I'm a big trend guy. I'm a big believer in the various Dow tenets, which includes the one on trend that says trends continue until they reverse, right? And when I remember when I first read that, I'm like, well, thank you, Captain Obvious, but he had a very valid point in that if you look at the trend, which for the 30-year yield is an incredibly long downtrend, right? Long-term downtrend. And so this has really been in place since the early 1980s. And so when I look at this, the thing that I always ask myself the question is where would in this case interest rates have to go in order to terminate this trend? And at this point, we would actually have to see interest rates above the 2018 levels, which were in and around 34.72 on your chart. It's probably we would read that out as 3.472%. And what's interesting about this right now is that you have a lot of focus on the bond market.
Yep.
And what's happening with the interest rates and how quickly they've actually gone up. But if you were to go back and take a look at the rate of change for interest rates from the first quarter of 2009 to the second quarter, the end of the second quarter in 2009 there, they went up much faster than what we're actually seeing right now. So there's a lot of attention that's being placed on the Fed and where we are in this interest rate cycle and what they're going to do with bond purchases. And, inflation has kind of come up a little bit more. And, for me, in order to really kind of get that shot across the bow that says, okay, this downtrend that's been in place for nearly 40 years is about over, we actually have to see interest rates north of 3.5% to almost 4%. So until that happens, I'll recognize the short-term weakness inside of bonds. But if I see that, that short-term trend actually terminates, it might actually lead to a pretty short-term bullish opportunity, kind of going back to what your third guest said, because if there are a large number of individuals short right now on those products, and interest rates do top out around that 3.5% to 4% and start to decline again, or even if they started to top out here, because there is actually a spot on the chart there's the concept of old support becomes new resistance,
Right.
and we're basically trading in and around that area right now. So I think we're at a pretty important spot in the short term that could result into kind of an easing in the yield and starting to kind of move back down towards those lows from early last year. But I wouldn't go so far as saying right now that this long-term downtrend is over, right?
Yeah, I've got the picture up here, so I'm drawing along, but I want to narrate some things. You guys saw I put line in the sand. I agree with Scott as well. I think that, while we are seeing yields spike, when we take a step back and look at the big picture, and this is what I love about the granularity of financial markets, if we looked at it over the past 6 months, you're going, holy crap, we are seeing a colossal rise in rates. And yes, it is, but putting it into perspective historically, it's really not that major. One thing that's of interest for me is Scott pointed out that 3.5 mark, which I agree. I think the 3.5 level is probably the most logical line in the sand. We are at a point, literally as we speak, at call it 2.4, 2.36, where we rallied up through today, going back into some highs from just a few months ago, actually, not a few months ago, back to the December highs of 2019. So that might also be a stall point, but if we do finally get above 3.5, let's run through different scenarios here. If we get above 3.5 on the yields, it's one of those things that it'll start to trigger almost anybody who was sell-side bias, meaning those who were short, because now all of a sudden you're seeing it make a significant higher high. That would trigger more people buying into the yield, meaning buying bonds themselves, because you're going to get a better yield here than you will on most dividend-paying stocks. So Correct me if I'm wrong, but wouldn't this potentially create a significant sell event for the equity markets as people go to buy the yield?
Yes. So ultimately what's going to end up happening, and a lot of it really just depends on the type of pricing models that the institutions use. A lot of them will take into consideration the risk-free rate of return using various maturities for bonds, mostly short-term. But you start to see the yields actually increase in some of these longer-term maturities. You will see money rotating out into those areas. And so what'll most likely happen is that you'll see a lot of demand for the new issues of bonds. Because basically in order for the yield to maturity for these bonds that are currently in existence right now to actually become as attractive, the prices on those are actually going to have to decline quite a bit.
Right.
And so what'll end up happening though is that we could very much see not necessarily an exodus in equities, but we could see less demand on the equity side, more demand on the bond side. And I hate to keep it so generic there because we don't know exactly what's going to happen.
Right.
But if you were to take a look right now at what's happening to some of the big tech names, right? So your Apples and your Microsofts, they have not been performing the way that they have been in years past. And the correlations that it's me, myself, and I, and some others that I've shared it with, and I'm sure many of others. But when you take a look at short-term correlations, the current correlation right now in the markets has appeared to be, at least up to this past week, interest rates going up, dollar goes up. Bond prices go down along with that because of obviously the inverse relationship between interest rates and bond prices. But we've also seen weakness in the equity market. Now, I can't say that the equity market's gone down per se because it's only been in a correction during that kind of mid-February to early March timeframe. But the NASDAQ, on the other hand, has actually been pretty weak. And being that when you look at the S&P 500 and how it's constructed, the top two sectors within its weighting comes out to just north of 40%. It's XLK, which is technology, and XLB, which is healthcare, a lot of biotech, which is obviously a big components within the NASDAQ. And so if you start to see that those two sectors in particular continue to act as a weight, if anything, it might slow down the rate of appreciation in the uptrend, if you will, of the S&P 500 that we see on like the weekly and the monthly charts. We can see that the NASDAQ actually breaks down. And so when it comes down to it, bonds historically have been a leading indicator for bond prices have been a leading indicator for stock prices in inflationary environments. When you're in a disinflationary environment like what we were during the prior decade, the 2000 period,
right?
That was more of a disinflationary environment. So you had that inverse relationship between stock prices and bond prices. So bond prices would go up, stock prices would go down, and vice versa. So now these things are kind of linked together. So it's a very, very different battle, if you will, that money managers are having to face today versus what they had to, let's say, a decade ago.
Sure. Is it one of those situations where you have to kind of step back? Because if you know that there's a historical, let's say, inverse relationship, and all of a sudden there's this tight correlation, is it one of those situations where you step back and say, okay, one of these is broken, I will wait and see till it reverts back to its normal? Or could there potentially be a decoupling of this historic norm of inverse correlation? Now all of a sudden we will see it. The new norm is it's correlated together.
Yeah. So if you were to go back to like the 60s, 70s, right? Okay. Very much correlated. Okay? Right. But the thing is that, if like, I mean, you and I weren't around in the markets in the 50s and the 60s, right?
70s, I got it, but no, not in the 50s. Right. I'm a little young.
But right. So that, we have, my point here is that we have, at least 1.5 to possibly 2 generations of money managers that have been around that, unless they've actually studied the markets historically, they don't know that those relationships exist or existed, right? Yep. All they've known is what they've seen during their career over the course of the last 20, 30 years. And so as we take a look at what's happening right now, yeah, it could be an eye-opening event for these individuals. And once it becomes a little bit more popular, if you will, that could become the trade for the next year or two, or possibly even the next 10 years, because these types of events, they don't tend to be just short term. They can develop into long-term cycles.
One of my, I say key takeaways here, but one of the important things I think everyone needs to understand is when I started off, and I'm going to play ignorant here and make myself the bad guy, but when I started off, I was very ignorant, and I thought, the equity markets runs everything. It's all about the stock market, and then you have these little things like currencies or futures or forex or options or bonds that, they're the little parasite fish that just suck on the stock market. And you come to realize that that's not the case, which is why I actually like that you start off your Beck with bonds, because to me, this is more of a dog that wags the tail thing. And I think if we can't stress enough, or I can't stress enough, the impacts that this current bond situation is going to have. And I don't know what that impact 100% is going to be, but we can start to formulate, just like we would in a what's it called, a Rube Gimbrick? What's that? Not Rube Goldberg toy, where like someone sets up all those little things and the ball rolls and hits one thing and all. They're all interconnected. And as what I love about what you've done is you're kind of hypothesizing. Say, well, if this happens, then I believe that this will happen. And we can start to plan out what that impact might be. Because to me, the bond market is going to create way bigger waves than, let's say, somebody like Apple having a missed earnings announcement. This will be a much bigger wave that moves the entire ocean versus Apple, creating some nice waves, but not moving everything.
Yeah, so to kind of put it into maybe a slightly different analogy, this would be a tectonic shift.
There you go. Yeah.
Right, because you have plates that are shifting. The ocean's constantly in motion, but like when you get tectonic shifts, that can be a very
devastating,
widely felt event, and it could be very devastating. Yeah.
Well, I think if you're on the wrong side, and that's why I love doing this and talking about it, because I think the more aware we are of it, the more we can prepare and build on it. And, the question is, how do you position yourself for these things? And, of course, as the events unfold, we'll be looking at the positioning of it. All right, let's go from bonds to equities. Obviously, there is great action in 3 of the major indexes. You have the Dow. I'll actually bring it up for the viewers out at home so you guys can see this as we go through. I guess I can bring that up here. Here is what do I got, a monthly? Let's go, I'll do a daily just so we can get the most recent pops up here in the equity markets. But I don't have the Dow on here, but here is the S&P, which as you guys can see, ripping to all-time highs today. Here is the Russell 2000, which as you can see, ripping to all-time highs today. And here's the NASDAQ. Wah, wah, not quite there. Walk us through what you're seeing with the equity markets and what it might spell out for those markets going forward.
Yeah, so, considering what we just talked about in regard to the bond market and the potential negative impact to the equity market, I think it's important for your listeners to understand that type of prognosis, if you will, about what the market could do, that's something that could unfold over the span of 5 to 10 years.
Right.
But at some point it begins, right? Now, having said that, am I bearish on the equity market? No. As a matter of fact, I believe we've talked about this before, but I have targets on the S&P 500 still at 4,600 S&P on the cash index, right? And we hear that figure and we say to ourselves, my gosh, 4,600, we're at 3,900 right now. Yeah, that's only 15 to 16% away. That could literally happen within the span of a quarter, right? If the market was to become very, very strong. I don't necessarily see that strength happening right away. Going back to what we talked about a little bit ago, technology and healthcare are two of the largest sectors as of the end of last month. The S&P 500, they come out, Standard & Poor's comes out at the end of every month, and they'll tell you, how much weighting there is in each of the 11 sectors that actually builds up the S&P 500. And when I go through and I take a look at this, I'll take a note to how heavy the top 2 are, how heavy the top 3 are, the top 4, the top 5. I'll also pay attention to where the different sectors are in their ranking, for instance. So to give you an idea, energy, which was the bottom sector, going back 2 months ago, is now, let's see, that's 2, 4, 6, 7th, 8th place now, which doesn't sound significant, but the fact that it's actually come up to 8th place from 11th tells me that energy is strengthening, right?
And look, real quick, as you go there, viewers at home, if you take a peek at this chart, what I'm showing you now is another way to analyze what Scott's talking about. This is just what's called a perf chart, a performance chart. It's just a price percentage, basically. On the hard left edge, basically all it is, I linked all these major market sectors that Scott's talking about, which is looking at things like financials, energy, healthcare, utilities, industrials, consumer staples, things like that. And putting them all at 0 on January of this year, right? Notice that right now, they're all doing pretty well. I think S&P's up 7.5%, but there's some other ones in here that are doing very, very well, right? I believe financials have been on an absolute tear. They're up 18%. Yes. But here's energy. Energy's up 39% on the year. I mean, talk about a change. This has all of a sudden become the hot dog. Anyway, I just wanted to show different ways to break it down, and I've got it broken since the beginning of the year as a visual for you.
And so everything that you just pointed out is actually very critical in terms of understanding like what the S&P 500 could do. Because this morning when I did my weekly overview, I mentioned the strength coming from financials. I mentioned the strength coming from energy. And the reason why that's so important is because when you take a look at what's happening with the S&P, right? Last week we were just at the doorstep of making a new 52-week and all-time high. But we didn't quite get there. And to your point, the NASDAQ was just womp womp. And so you ask yourself the question, well, why? Okay, so if information technology and healthcare aren't doing well, there's got to be other sectors that are lifting up the S&P 500. And one of the interesting things about, again, kind of the change in rank, financials had been the 5th, sector, if you will, in 5th place for quite some time. It had been in the top 5 for at least a year and a half, but now it's in the top 4. And communication services is now in 5th place. But you take a look at the top 3 sectors: it's consumer discretionary, healthcare, and information technology in terms of weighting within the S&P 500. And if those start to actually show signs of strength, then what that would do is basically accelerate a rally within the S&P 500. Now, what do I think from a sentiment standpoint it would take in order to do that? I do think that interest rates would have to top out in the short term, and you'd start to see bonds stabilize a little bit, again, in the short term. in order to see the sentiment change here within the equity market and really kind of get this back into a mode to where it was rallying the way that it was at times last year.
Yeah.
Because when we take a look at the rally, for instance, in the fourth quarter of last year, that was a pretty nice rally. That was upwards of almost 20%, and I'm saying almost because I'm kind of ballparking it there from the lows to the highs. So it was pretty nice in terms of that fourth quarter. But so do I see the equity market tanking anytime soon? No, not anytime soon. But one of the things that I think is really important here, and you were kind of talking about this, about monitoring shifts.
Yep.
This is the very reason why I look at those monthly and weekly charts every month, right? It might seem monotonous to certain individuals, but this type of routine, regardless of the markets that you look at, it will help you understand what's happening in the big picture. Even if you're a short-term trader, understanding the big picture definitely will help you out in understanding where it is that the markets could go.
Yeah, and I love that page that you just sent. So thank you for sending that one. I just shared it with the audience. It's kind of nice to see this breakdown. This is something we talk about in like Proactive Investor as well. Imagine, guys, that this was your portfolio.
Exactly.
One of the things that we talk about is rebalancing. And at this point, I think you guys can all look at this portfolio. Let me zoom in a little bit higher. This isn't specifically any one in particular's portfolio. This is the breakdown of the S&P 500. You'll notice more than double any other market segment is information technology. So if this was supposed to be a balanced portfolio, you would be saying to yourself, I need to sell information technology and maybe look at some of these ones that have been underperformers like real estate or utilities or materials or energy, which are all under 3%. So, this may be that moment where you're starting to see some rotation, and energy's been a hot one, financials have been really hot, but you might see some other areas here. Of course, you probably would be better off including some sector rotation timing, et cetera, to help optimize that. But I think it's very interesting to see how overweighted this has become with information technology, and we might see that rotation out.
Yeah, and I think you're already starting to see it because one of the other aspects that I look at on a monthly basis is the relative strength ratio of each of these sectors versus the S&P 500. Mm-hmm. And, I look at it in the order of the sector rotation according to like the traditional Sam Stovall sector rotation model that was put out by the S&P. And, one of the things that I've noticed is materials started to strengthen first, industrial started to strengthen shortly after, and those are two sectors in particular that when an economy, within the market cycle, when the economy starts to kind of solidify a little bit, you start to get into more of that kind of mature bull market. There's actual physical demand for those raw goods and services to be manufactured or mined, manufactured and shipped. You start to see these sectors doing well. And then from there, it starts to bleed over into energies and then staples and healthcare, et cetera. And so right now, going back to what you mentioned earlier, energy has been on fire, but so has materials and industrials. So from a sector rotation standpoint, these areas are starting to show signs of strength. And I say signs of strength in a way that we haven't seen them demonstrate over the course of the last 10 years. There's been short-term bouts where, materials might do well for a week or two, but not to where you have like a prolonged outperformance over the span of 2 or 3 quarters. Mm-hmm. And now we're on the fourth quarter of this relative outperformance of these two sectors versus the S&P 500. So I think from a long-term rotation standpoint, we are starting to see that. I wouldn't be surprised to see these top 3 sectors kind of fall out of rank eventually. It's going to take a while for technology because it is so big, but we're seeing that. And what I'm not seeing is rotation into some of the more traditionally defensive areas like consumer staples and utilities. If I started to see rotation into those areas, especially in a major way, then I would be a little bit more concerned about the markets right now.
Yeah.
Financials and the strength that we see there, it's a little out of cycle, but a lot of that could actually have to do with where the interest rates are actually at right now, and where they're able to actually continue to borrow at from the Fed. Because if they can continue to borrow from the Fed at relatively low rates and lend them out at longer rates, they're going to make a ton of money, right? So I know these big banks are just loving what's happening right now.
Well, yeah, the higher that interest rate is, the more that they can charge for it. Question from Medic Man Down says, so start building a shares position in SH. Well, remember, that is SH is an inverse S&P. So that's 1-to-1 inverse. So if the S&P 500 goes up 1%, SH should drop by 1%. Now, that makes the assumption, Medic and others that are thinking about shorting the markets, that the markets are going to roll over. I, for one, agree with Scott at this point. I think you need to... I don't think we're going to get to 4,600 before we have a significant crash, but we could. That said, if you're thinking of shorting the markets, you got to let the market prove to you that it's making some new lows. And, I mean, just take a peek at what's going on with the S&P 500 right now. Do you see any... Does this look weak? I mean, this I'm sorry, but it doesn't look weak right now. So, and there's no overhead supply, so you're not shorting at a supply level. You're not shorting anything other than opinion that it's going to come crashing down. It's better to wait, to leave some money on the table, let this thing sell off and prove to you that it's making some new lows or whatever your trend reversal criteria is, and then. But yes, if you do find yourself in a downtrend, SH might be a great buy opportunity. And there's also inverse leverage ETFs as well, which are a bit more dangerous. But if you've got strong conviction that things are going to move in your direction, then go for it.
Yeah, and I think it's important for a lot of your listeners to know that, just because these inverse products exist doesn't necessarily mean that you should use them. Most of them, look, if you go to a bank and you tell them, I want this, and you're willing to give them enough money to do it, they're going to do it, right? And they know that the risk is all on you, so it's no risk for them. When it comes to these inverse ETFs, right? A lot of these are going to be based on options. They could be based on futures. And when you do look at the long-term trends on these, a lot of them are going to have just a really nasty-looking chart. So you've got to be right in your timing in the market if you're going to use those inverse ETFs or those inverse products. And so, to your point, there's no supply in the market right now. The S&P 500, it just put in a new swing low. It just confirmed a new swing low today as of the close, because we had a close that was above the prior swing high at 39.50. And so now, if I were in their shoes and I said, okay, well, I am going to look for opportunities to short. Okay, well, again, trends continue until they reverse. Where would that termination of this uptrend be indicated? Well, I would need to see a weekly close below 37.23 at this point. And I say a weekly close because we could have a situation where the markets dip down below that area for a day or two, but then close up for the week and completely negate that signal. Mm-hmm. So that is what I would be watching at this point. But again, as the markets continue to trend higher, that number gets higher because 4 or 5 months ago that number was down at 32.14, and now we're at 39.68. So you tell me what direction the market's going.
3 steps forwards, 2 steps back, right?
Yep.
In this case, it seems like 3 steps forward, half a step back, but at some point that will change.
Yeah.
All right, we've gotten a few different assets out of the way, and I certainly want to keep us on track here. But we got bonds, we've got equities. Anything that you notice in the currencies and commodities? I mean, actually, let's do commodities then currencies. I'm pretty sure oil is of concern, not of concern, maybe that's the wrong word, but of interest as of late.
Well, what's interesting about crude oil, right? And again, I love doing this analysis on the monthly and the weekly charts because we've talked about this before, and the beauty about doing these types of things is that you can draw on your charts and you can come back weeks later and look at it and be like, I was right.
Or I was wrong.
Right, or I was wrong. But I did this. If you have a chart of crude oil, if you measure from the lows there from April of last year to the highs in around September of last year, so about that $6.50 to $43, almost $44 area. If you were to measure that and project that from the low that took place in November in and around $33, almost $34, you can see that measured move we have kind of met that expectation. We have gone 100% of that distance and then some. And what's also very important here is that when you do look at where we are within the context of that weekly and especially the monthly chart, you can see that we are trading up towards areas of supply, so spots where the market has broken down before. So it would be very interesting to me to see what actually happens here. Now, of course, there's been a lot of talk about how there's been an increase in the demand for crude oil. And as we do go from this kind of COVID lockdown to possible reopening of economies around the globe, then we could certainly see crude oil get north of that that $79 area, almost $80. Actually, I guess that's about $77 to $80 that we saw back in 2018. However, being that we are back at a pretty interesting resistance / supply area, I'm looking for a little bit of a correction here, and I wouldn't be surprised to see if over the course of the next 2 to 3 quarters, 6 to 9 months, we see prices come back down from about the spot that we are right now down to about that $40 area.
Well, and $40, huh? All right.
Well, yeah, I know, and when you look at it, you're like, dude, that's quite a fall from where we are.
Yeah,
here.
40%.
And keep in mind that's over the span of 6 to 9 months.
Yeah.
Not 6 to 9 days. That would be one heck of a trade. But when you take a look at, for instance, the decline that we saw in October of 2018 to the lows there in December of 2018, you had a relatively equal drop in what I'm sharing with you right now, in terms of like the extent. So it's not to say that it's not possible. I mean, that happened in the span of 3 months, right?
Yep.
So that just kind of goes back to putting things into perspective and what can the market do? Now, of course, if it gets out beyond that $77 to $80 area, then all bets are off there. The next kind of stopping ground, if you will, would be in and around that $90 to $112 area that we saw back in 2013 through 2014.
Yeah, and a lot of people thinking, it's funny because I see Big Eb say it's $100 crude, thanks Uncle Joe. I mean, it's not out of reason, Yeah. I could see it being $100 again, no problem.
Yeah, trust me, it's not because of Joe Biden, right? I mean, I hate to throw politics into it because there's like what president in their right mind is going to actually want to have higher gas prices for its constituents. Nobody in their right mind would actually do that intentionally. Yeah. It comes down to market forces, right? Yeah. And last I looked, we're not the big players on the stage, right?
Well, we think we are. I mean, there's a lot of different factors out there that are moving it, but I think what's interesting is if we go back to your analysis on the yields on the 10 and the 30 year, we are seeing since 2009 this pronounced downtrend. And I think you're right. If you get above that 70 mark, which to me is the next logical line in the sand, we're pretty much there anyway. If we get above that, though, then all of a sudden it's similar to what we saw with those yields. You're now triggering a bunch of people's mindsets to change from a bearish stance to a long-term, maybe bullish and new trend forming. Of course, it would have already formed, but that means just confirmation of the trend. And that to me would be, a close up above that 70, 72 mark. It's very, very possible that happens. My main target was closing $48 gap, and we did that pretty quickly, and you're still running. So,
yeah, and to your point, I mean, it's like if you just play connect the dots with the highs from back in 2008 to 2013, we're pretty much right there, right?
Yeah.
In terms of like a trend line break, personally, I would like to see it out above that $75 area, because I personally, I like to see highs and lows broken as opposed to just trend lines because there's too many instances where I've seen a trend line closed above and the next thing you know, it's going back in the opposite direction. But if that happens, right, then it's very possible that you could see like that 2000 era oil market again. Now, do I think that we'll get up to like $147 crude? I don't know. But, the long-term trend at that point will have been terminated, and from a secular standpoint, trends that can prolong or persist rather for 12 plus 18 plus years, it's very possible that we could see some long-term increases in oil. Not to mention that if we think about it from a sector rotation standpoint, we are seeing strength in energy. Why would energy stocks actually be doing well? Well, it's because their main product, which is oil, is actually starting to trade at higher profit margins. They're doing well. Crude oil continues to do that. We'll probably continue to see energy stocks going up. I mean, they are coupled to one another.
Yeah. Oh, man. We got a lot covered there, Scott. We got bonds. We got equities. We got commodities. Currencies, I guess maybe we could sprinkle a little bit of the dollar in there if you got any input on the dollar index, but I don't want to take your time too much longer. We've seen, especially on the weekly basis, a similar picture, obviously from 2020 through where we are today. That dollar's had a pretty precipitous decline. We are starting to make some shorter-term highs, but do you see this bottoming out at this 90 mark, or are we headed for even lower lows?
So this is something that I've been talking about in the guided pathway sessions almost every morning for, I don't know, gosh, the last couple of quarters. When I look at that weekly chart and I see relatively equal highs, what goes through my head, again, being a trend guy, is relatively equal highs is half of the definition of a sideways trend. So the other half of that definition would be relatively equal lows. Well, we've come back down to that demand area in around that 90 to 88 spot. And, from a fractal standpoint, you start to drill down into that daily chart, the 4-hour charts. We have seen a trend reversal formation, at least on that 4-hour chart, that suggests that higher dollar could be on its way. I think the critical spot to really watch and confirm is getting out above 94, which, at that point, a lot of people would be like, well, dude, your move is about halfway over.
Yeah.
Well, you're also inside of a sideways market, so keep that in mind. But, from an intermediate to long-term standpoint, you confirm that, then you're probably going to see that 102 to 103 area. What would that coincide with? It would most likely coincide with higher interest rates, lower bond prices, et cetera. So it just kind of goes back to our prior thesis.
On this chart, guys, if you're looking at the daily, which obviously is not as wide scope as the weekly or monthly, you can see that for this year, it has been making higher highs and higher lows. So, I think if we can continue to see higher lows being put in, then that 94 will probably be challenged. And, of course, a strong dollar will not have a very positive effect on the market. So it's interesting to see the discussion about bonds, then the discussion about the currencies, both potentially showing some bearish pressure on the equity markets going forward. Not that things are going to change right now, but again, these are those bigger picture cogs in the machine, if you will, that down the road could potentially elicit some significant changes.
Yeah.
All right, Scott. So can you talk about? Okay. This is for tomorrow morning, not for today. I'm going to leave it because you're already at time. But Lisa is one of our regulars here. Says, Scott, can you talk about trend tomorrow morning? So talk about trend tomorrow morning. Not in here. We'll leave that for your
I think I might know who that Lisa is. Yeah, she's a regular attendee in our guided pathway sessions, and so I try to, inside of those sessions, it's tough to not kind of revert back to kind of a teaching mentality. When I first started doing the sessions back in August, a couple of the comments from some of the students are like, oh man, these remind me of like the bank calls that I used to have to be on, because I don't know if, not a lot of people have kind of worked on the institutional side, but if you remember the movie Wall Street, kind of like in the very beginning of the film, everybody's in there. It's early in the morning. The bell's about to go off, and the guy is in the office, kind of doing his general announcements. You need to look at these products today, and you need to sell this and that and this and that. So it's kind of the same thing. When I go through the markets every day, I cover like 11 markets every morning, and I do this in addition to going through the economic announcements, earnings announcements. And I try to squeeze it all in within about 20 minutes. So it's a fairly fast pace.
Well,
so needless to say, it doesn't afford too much time for teaching.
Yeah, sure. I can tell. Yeah. Well, I'm sure you always tend to get all the information you need in. So
I try.
All right, Scott. Hey, well, thank you so much. I love our once a month meetings. I know we were supposed to be the first week, but I dropped the ball and had to reach out to you later. But I'll try to get you back on the first week of April. Not on April Fools, because then it just seems like it's all a joke. But I appreciate you taking the time to talk about the Beck Report, bonds, equities, commodities, and currencies. Thank you so much, and hopefully all's going well, and I'll talk to you soon.
Yeah, thanks for having me on. You guys take care.
Bye. Guys, that was Scott McCormick. You can follow him on, obviously he's got Twitter as well. If you go to the MyOTA page, which I showed you guys earlier, I'll see if I can bring that one back up for you. You can find his calendar. He is busy every day in that XLT, in the mastermind sessions. And then on Friday mornings, he does a GPS, which is guided pathway sessions. And then he's got an all asset class mastery on Wednesday. But there's there's his schedule out there. Always encourage you to check out any of the instructors here. One of the things I hope that you gathered from Mr. McCormick's conversation here today is how methodical he is, how structured he is, unemotional he is. It's all process. It's all saying, well, if this happens, then this is most likely going to happen. Not it is going to happen, most likely going to happen. And that's one of the things I really love about Scott is how he'll look at everything objectively and just say, I can't force my opinions on it. This is just what I've seen happen historically, what I've read through all these textbooks, etc., because he is a CMT, which means he's like the super nerd in a very good way. So anyway, hope you enjoyed that one. If you want to see more from Scott, check him out in his daily market overviews, the GPS sessions, etc. All right, I am quickly running out of time. So let me go to your economic calendar for tomorrow. Here's what we've got cooking for tomorrow. There really was actually good news out there today. We had TIC long-term purchases numbers, and I believe there was another piece of data that came out better than expected. Of course, right as I want to remember exactly what it is, I forgot. It'll come back to me in a moment, I swear. I think it was Empire State Manufacturing Index numbers. Those numbers, if memory serves me, they were expected to increase from like 12 to 14 or 15, which obviously anything above 0 is good. Came out at 17, which is a good number. And then TIC long-term purchases, which means who's buying U.S. products, bonds, and equities. That one came out a little bit less than expectation, but not a major problem. Here's what's cooking for tomorrow. The bigger news here is retail sales numbers. Now, I don't have the chart of retail sales up here for you, but you guys can see that the previous number, I'll put a red box around all the U.S. stuff. The previous number was 5.3% gain. That's great. Obviously, as a consumption-driving economy, we want consumption. Retail sales, spend. Get that stimulus check, go straight to Walmart, buy yourself a new TV. I'm being very sarcastic. Please save that and pay down your debt so you're debt-free when all this stuff ends. Retail sales was expected to go from an increase of 5.3%. They're expecting to be negative 0.5%, actually a contraction in retail sales numbers, which is surprising to see that kind of a shift. That said, the previous number was, we beat expectations. It was slightly positive. The expectation was slightly positive. We came out at 5%. So it'll be interesting to see what happens tomorrow. It almost feels like they're setting that bar too low, just so that when the number barely comes out like 0.5 positive, like, hey, we beat expectations. It was growth as opposed to contraction. It seems like we always set those things up. It's like earnings season, right? You'll see a company report earnings that are just appallingly bad. But then what you notice is that the last release, they said, oh, we expect our numbers to be, let's say, we're only going to make 10 cents per share, and they ended up making 11. So it looks like they beat, but the year before they were trading, making $1 a share. Adjusting and manipulating these numbers is what the industry does. What else do we have cooking for tomorrow? We have the retail sales numbers, obviously, is the most important one. That's going to happen 1 hour before the equity markets open. You also have industrial production and business inventories, as well as capacity utilization rate. Other than that, not too much major stuff going on. You do have the ZEW Economic Sentiment Report coming out for European Union and for Germany. That is expected to increase as well, which is a good thing. It means economic optimism there. That's going to be at 3 a.m., so way in the early hours of the morning for anybody who's trading up that early. Big Ed says, yes. Now you can buy a full season luxury suite for the Oakland A's for only 1 Bitcoin. Yeah. Well, the good news is the ticket price got a lot cheaper today, right? It fell pretty significantly over the last 48 hours. You guys saw it hitting 62,000, and all of a sudden we're back to 66,000. Sorry, 56,000. So you saved yourself $6,000 if you bought it with Bitcoin today. But yeah, you can now buy a suite for the Oakland A's. That doesn't say much because there's not that many suites there. But interesting that they would offer that. If I lived up there, I might consider that. Although I don't want to spend my Bitcoin on anything right now. I want to keep that for a long, long time. All right, and I agree with the Big Gap. I would rather see if I could do that with Ethereum. I think Ethereum would probably be the better one as a spending currency. Bitcoin, let's keep that one locked up. All right, that is going to do it for today. Obviously, again, if you want to talk or see more from Scott McCormick, easy to do. He's with Online Trading Academy, covers a ton of markets almost every single day. I don't know how he does that much work on a daily basis, but hey, every day he just walks through all these different markets and maps out supply and demand zones. Tomorrow will be a very different show. We have not done one as TraderMerlin. When I did it as Power Trading Radio, we had real estate on quite a bit. There's been a lot of talk about the current market situation as being an unbelievable seller's market. I have been up in Big Bear shopping for a place up there. It has been just crazy. Houses don't last more than 3 days on the market before they have multiple bids. There's one in particular that I was bidding on, 17 offers on it. We had to bid overpriced. It was just a mess. It's the current state of the market, right? As everyone's trying to lock in that very low 30-year fixed rate mortgage. Tomorrow, Diana Hill, fingers crossed, will be on. She's been super busy and traveling as well. So we'll talk real estate with Diana Hill tomorrow. Get a sense as to what the pulse is overall for real estate. What might we be thinking with regards to our own investments or homes that you own? Is now maybe the time to sell and get a big premium and rent for a year, or maybe even go out and buy something and take advantage of this really cheap 30-year fixed rate mortgage before it starts to run up. So if you have questions regarding anything to do with housing, real estate, do me a favor, go to TraderMerlin.com or just email me at TraderMerlin@gmail.com. That's probably the easiest way to send me an email. Let me know what it is regarding real estate that you would like to discuss, and I'm happy to get through all that with Diana Hill on tomorrow's show. Anyway, that will do it for me. Happy trading, everybody. I will see you on Tuesday's show. Take care.